Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Oscar Health, ticker OSCR.
Yeah, and this is a really fascinating one. We're talking about some genuine high-stakes volatility here.
Yeah.
Oscar Health, it really sits at this interesting crossroads, doesn't it? You've got the
Yeah.
Silicon Valley tech-first ambition
Right.
butting right up against the incredibly complex world of healthcare regulation. They call themselves a tech-first insurer.
Yeah.
They want to completely change how the system works.
And they definitely had a moment, didn't they, post-pandemic, fueled by those federal subsidies, the enhanced APTC?
Absolutely.
Their membership just exploded, past 2 million lives. But, and this is the big but, that incredible growth came with some really painful losses, which I guess sets up the core issue we need to figure out.
That's exactly it. It's a paradox. Their whole tech thesis, it's facing this massive financial stress test right now, driven mostly by things outside their direct control. So the whole analysis today, for us and for you listening, it really boils down to this one big question.
Okay.
Is this supposedly revolutionary tech-first company actually ready for what looks like a mandatory market reset coming before 2026? I mean, their survival isn't just about fancy code anymore. It's about cold, hard financial discipline this year.
Okay, so let's unpack that. To really get why Oscar's current strategy feels so, well, radical, we probably need to start right at the top. The CEO, Mark Bertolini. Because this isn't just spreadsheets and restructuring, is it? He talks about it like an evangelical mission.
It really is. And that mission, it's deeply rooted in some pretty profound personal tragedy. The sources we looked at, they detail these harrowing experiences he had with the traditional healthcare system. And that experience, it seems to fuel his drive to change it. It gives the whole thing a different kind of weight, not just another corporate turnaround.
Yeah, the background is striking. We're talking about two huge, life-changing brushes with the system's flaws. First, that skiing accident. Really severe.
Yeah, just devastating. Broke his neck in 5 places, C2, C3, C5, C6, T1. And the result was, 18 years of chronic, debilitating pain?
Yeah.
I mean, the sources say he often slept maybe an hour a night. It got so bad he actually considered assisted suicide at one point before finding alternative treatments. When you go through something like that, when the system just fails you on such a basic level, your whole view of it changes, fundamentally.
And that wasn't all. There was also the family tragedy with his son.
Yeah, his son, battling incurable cancer, needed a bone marrow transplant. And that experience, it led Bertolini to actually quit his job. He was a big exec at Aetna before this, and he moved into his son's hospital room for 18 months.
18 months living inside the system like that.
Exactly. That kind of deep immersion, the bureaucracy, the paperwork, the lack of real human connection sometimes, it drove a complete shift in him. He talks about his old corporate self, called himself the Terminator at Aetna, versus how he sees things now. He's basically declared war on the very structures he used to work with in.
And he doesn't mince words when describing that old system, does he? He calls it a collection of competing economic models run by cottage industry people. That definitely paints a picture of something outdated.
Yeah, low-tech, fragmented. His big critique, philosophically, is that healthcare today is just reactive. A break-fix operation, he calls it. It kicks in when you're already sick, often catastrophically so, but it totally fails on the proactive side, focusing on the person, their quality of life, preventing bad outcomes. The incentives are all wrong, volume over value.
And employer-sponsored insurance, ESI, the way most working Americans get coverage, he takes aim at that too.
Oh, absolutely. Calls it an outdated system designed like 80 years ago, leads to runaway costs, and in his view, these kind of average benefits that just don't meet individual needs. It's not personalized.
So his new mission, this evangelical mission, stems from realizing something key about health outcomes.
Right. The idea that your ZIP code matters more than your genetic code. That where you live, your environment, your social determinants, those are huge factors in life expectancy. And Oscar, the company, is meant to be the tool to build something different, something personalized, digital, consumer-focused that can actually target those social factors, moving away from the employer model towards the individual marketplace.
Okay, so that mission directly connects to their big claim, the technology moat. They say they built the first new health insurance platform since, 1972? Enabling this fly digital model.
Yeah, that 1972 date is really key. It highlights that basically all the big legacy players, they're running on code and systems designed decades ago. Piled high with manual processes, paperwork. Bertolini literally says they're drowning in paperwork.
So the fly digital model is the opposite.
It's supposed to be. Total automation is the goal. Zero friction, zero errors. right from that first click when you sign up.
So if it's all automated, where do the immediate savings come from? How does that work?
Well, the idea is you cut out the middlemen and just slash the traditional admin waste. Legacy insurers, they depend on these huge networks of agents, brokers,
Mm.
who all take big commissions, right? Sometimes up to 10% of the premium. Adds layers of cost and bureaucracy.
Oscar bypasses that.
That's the plan. Sign up, claims, managing your policy, talking to member services, it all happens directly on their cloud platform. It's meant to be a built-in structural efficiency advantage right from the start.
Okay, but that's the theory. Is it actually showing up in the financials? We need to see it in the SG&A numbers, the selling, general, and administrative costs.
Yeah, absolutely. And we are starting to see some proof. They reported a pretty remarkable 14% reduction in back office functions just since April 2025.
14%, that quickly.
Yeah, in just a few months.
Yeah.
Which suggests their automated cloud-based platform is faster and more efficient than competitors trying to bolt AI onto, ancient mainframe systems.
That's a huge cut in 6 months. But is it sustainable? Or is that just the easy stuff, the low-hanging fruit? Legacy guys might say they've already trimmed that fat. Is this a real structural edge?
Well, management argues it is structural. That efficiency gain, it helped push their SG&A expense ratio down to 17.5% in Q3 2025. That's 150 basis points better year over year. And they believe there's, quote, more room in our SG&A for more cuts.
Why? How?
Because the fixed costs of their platform get spread over more members as they grow. So they should gain efficiency with scale, unlike older models where costs often just grow right alongside enrollment.
Okay, so there's the cost-cutting side, but what about the other promise of tech? Improving actual health outcomes for members. This is where their AI comes in, right? Oswell.
Right, Oswell. Powered by OpenAI. And Oswell is crucial because it's meant to connect that back office efficiency with the actual member experience. It's described as an industry-first AI agent plugged right into the platform. It pulls together claims data, medical records, notes from human care guides.
To do what exactly?
To personalize the experience. Deeply synthesize all that info.
And how does that personalization save money or improve health? What's the link?
It allows for proactive care coordination, not just reactive. They have this tool, Campaign Builder, that uses Oswell to spot members who might be at risk for certain things and then tailor outreach to them.
Are there results? Does it work?
Well, the source material points to some tangible results. A reported 13% reduction in ER visits for the members they targeted with these campaigns, and also more wellness appointments booked.
13% fewer ER visits. Why is that number so important for an insurer?
Oh, it's huge financially. ER visits are incredibly expensive, often the most expensive kind of preventable care. A primary care visit costs maybe tens, hundreds of dollars. An ER visit, thousands.
Right.
So if Oscar's tech can successfully nudge people towards preventative care, keep them out of the ER, that directly helps their MLR, the medical loss ratio. The tech is designed to make members more active in managing their own health, which ideally is cheaper for everyone involved.
Okay. So we've got this visionary, maybe even mission-driven CEO. We've got a tech platform built for efficiency and personalization. That's the powerful story, the upside thesis.
Exactly.
But now we have to flip the coin. We have to confront the immediate financial crisis that's threatening to just burn that whole thesis down, the MLR crisis.
Yeah, this is where the paradox really bites. Because on paper, the growth looked fantastic in Q3 2025.
Yeah.
Membership hit 2.1 million members. That's up 28% year over year.
Huge growth.
Huge growth. And revenue followed, right?
Yeah.
Total revenue, about $3.0 billion, up 23% year over year. But all that volume, all that growth, it was just swamped by the cost of medical care.
They lost money, a lot of money. Loss from operations was $129 million. Net loss, $137 million. Just for the third quarter. That growth clearly isn't profitable growth. Not yet, anyway.
Not even close. And the villain in this story is the medical loss ratio, the MLR. That's the percentage of the premiums they collect that gets paid straight back out for medical claims and things like quality improvements. Oscar's MLR in Q3, it spiked to 88.5%.
88.5%. That's really high, unsustainably high for a long-term business, especially when their target is closer to 80%. Right?
Exactly. And let's just pause on why that number is so dangerous. Under the ACA, the Affordable Care Act, insurers generally have to spend at least 80% or 85% of premium dollars on actual health care. If their average MLR stays too high, like above 85% over 3 years,
They have to pay rebates back to
right,
customers.
they literally have to cut checks back to members. So operating at 88.5% leaves almost no wiggle room for overhead, admin costs, taxes, certainly no profit. And yeah, it definitely starts flirting with those mandatory rebate levels. It's an existential threat, that number.
So what caused it? Why the sudden jump? It was up 380 basis points year over year. That's a big move.
Management points the finger directly at higher average market morbidity, which is basically jargon for their members, on average, got a lot sicker than they expected.
And why did that happen?
The main driver seems to be an external shock, the end of continuous Medicaid enrollment. When states started checking eligibility again, a lot of people lost Medicaid coverage.
The redeterminations.
Exactly. And many of those folks who often have unmanaged chronic conditions, complex health needs, they move straight over to the ACA marketplace plans, like Oscars.
And these new members needed more care sooner.
That's the issue. They tended to be higher utilizers of healthcare almost right away. More doctor visits, more expensive treatments, sooner than Oscar had planned for, priced for. And this big shift in the risk pool had a major financial consequence.
Which was?
That morbidity spike forced them to make a huge, painful accounting change. A $130 million increase to what's called the risk adjustment payable for 2025.
Okay, risk adjustment payable. Can you break that down quickly? Why is $130 million such a big deal here?
Sure. So risk adjustment in the ACA market is kind of like a Robin Hood system between insurers. If one insurer, like Oscar, happens to enroll a sicker than average group of people, meaning their members have higher risk scores, they're supposed to receive payments from other insurers who got luckier with healthier members.
Okay.
But if your members turn out to be way sicker than the market average, you might actually end up owing money into that pool to balance things out. That $130 million increase means Oscar suddenly realized they were going to owe a lot more money into that pool than they'd previously budgeted for. It reflects just how much sicker their members were compared to the average across the market.
Wow. So that $130 million adjustment, that basically explains almost the entire loss for the quarter.
Pretty much. It just hammers home how vulnerable even a tech-savvy company is to these big, external, policy-driven market shifts.
They did have some offsetting good news, right? Favorable prior period development.
Yeah, about $84 million, which means claims from previous years came in lower than they had reserved for. That helped cushion the blow a bit. But still, that sudden morbidity shock, that $130 million hit, that was the defining story of the quarter financially. And it leads us straight to their response, which isn't really optional. It's the mandatory 2026 profitability plan.
Right. Management seems to have drawn a very clear line in the sand here. It's a mandatory strategic shift. The goal is, quote, meaningfully expand margins and return to profitability in 2026. And they're targeting a stable MLR around 80% by 2027. So what's the main weapon they're using to get from that scary 88.5% down to a stable 80%?
The biggest lever by far is pricing. Very disciplined, very risk-averse pricing. They've announced a huge weighted average rate hike for 2026, approximately 28%.
28%, that's massive.
It is. And it's not just keeping up with inflation. This is a highly strategic defensive move. It's designed to build in a really significant safety cushion for their margins.
They're calling it stacking the risks, right? Deliberately pricing for a kind of perfect storm. I want to dig into that underwriting approach because it sounds incredibly cautious. What are the specific risks they're assuming all happen at once?
Okay, so there are four main layers they're stacking, and crucially, they're not assuming any offsets between them. First is high core trend. Basically, they're assuming healthcare costs, labor, new drugs, hospital charges keep going up sharply. No assumptions about costs stabilizing or them negotiating better deals.
Okay, layer one, high costs continue. Layer two.
Layer two is baking in that higher morbidity. They're assuming the sicker population they got in 2025 from the Medicaid redeterminations, that's the new normal. That higher utilization risk is now built into their base rates. They're not counting on people suddenly getting healthier.
Makes sense defensively. Layer three.
Layer three is program integrity costs. These are the administrative costs of meeting tougher regulations. More audits, stricter compliance, better documentation for risk adjustment, that all costs money, and they're pricing that rising red tape right into the rates.
Okay, costs, sickness, red tape, and the fourth layer. This seems like the biggest one.
It's the anchor risk, absolutely. Layer 4 is the explicit assumption that the enhanced APTC subsidies, those federal subsidies helping people afford ACA plans, will completely expire on December 31st, 2025. Vanish.
They're pricing as if the government's safety net disappears entirely.
Exactly. It is the ultimate defensive posture. And it explains why that 28% hike is so large. By pricing for this absolute worst-case scenario, high costs, tough regulation, sick members, and no subsidies, they ensure that if any one of those things turns out better than assumed.
Their margins improve immediately. Profitability becomes the absolute priority, maybe even overgrowing membership in the short term.
That seems to be the calculation.
But wait, if they jack up rates by 28%, how do they stay competitive at all? Won't they just price themselves out of the market and lose all their members?
That's the tightrope walk. And this is where their network strategy comes in. Even with this huge risk-stacked rate increase, their goal is actually to use their narrow, supposedly high-efficiency provider networks to still have the lowest or second lowest silver plan price in 30% of their markets.
Double what they had before. How?
Yeah, up from 15% previously. The idea is they're not just underwriting the member risk, they're aggressively underwriting the cost of the underlying provider network itself, trying to build plans around doctors and hospitals that are cheaper but still effective. That's supposed to be their structural advantage in the ACA space.
So the bet is their efficient networks can absorb that 28% hike better than legacy competitors who might need 30% or even 40% hikes because their own networks and systems are less efficient.
That's the bet, precisely. They want to land right in the pack on price not so cheap they only attract sick people, but competitive enough to potentially steal members from rivals who might be forced to price way too high.
Okay, so pricing is the big offensive-defensive move, but they're also cutting costs internally, right?
Yes, in parallel. They've targeted $60 million in administrative cost reductions, specifically for 2026. And this isn't just, hoping the tech platform becomes more efficient. It's a specific target, split between actual staff reductions and more tech and process improvements. Every dollar saved on SG&A goes straight to helping close that gap between the current MLR and that 80% target.
And on the financial discipline front, they also did some interesting things with their debt recently, something about reducing future dilution. That sounds like they're optimistic about the stock price eventually.
That's a really key technical point, yeah. They did a $410 million convertible notes offering, due in 2030, low interest rate, 2.25%. But the really interesting part for investors is that alongside those notes, they executed something called capped call transactions.
Okay, capped call sounds like Wall Street jargon. What does that actually do? How does it help shareholders?
Think of it like insurance. They bought insurance against their own stock price going up too much. See, convertible notes turn into stock if the share price rises above a certain level. If Oscar has a massive turnaround and the stock flies, they'd normally have to issue a ton of new shares, which dilutes everyone who already owns stock.
Right, waters down the ownership.
Exactly. The cap call basically neutralizes a lot of that dilution, up to a certain cap price. They bought options that gain value if the stock rises, offsetting the cost of issuing new shares from the convertible notes.
So they raise money now at a low interest rate, but they've preemptively limited the dilution if the turnaround works spectacularly and the stock price takes off.
That's the idea. It protects existing shareholders from too much dilution on the upside. It's a sophisticated move, and yeah, it does suggest management is preparing for and wants to protect shareholders from the potential upside of this whole turnaround plan. It signals some confidence they can actually hit that 80% MLR and get back to profit.
Okay, that sets the internal stage. The plan, the tech, the financials. But looming over everything is this huge external factor, entirely political, the policy risk, the subsidy cliff.
Yeah, this is the big one. The elephant in the room that could just trample everything else. Those enhanced APTC subsidies, the extra help making ACA plans affordable, they're set to expire, gone, end of 2025. And that cliff could just devastate the entire ACA marketplace, not just Oscar.
What kind of impact are we talking about if Congress does nothing, if they just let them expire?
The potential impact is just brutal for consumers. One source we saw estimated that without the subsidies, premiums for some people could jump by an average of 114%.
Double the price overnight.
Yeah, basically doubling the cost of health insurance for millions of Americans almost instantly.
And that price shock wouldn't just hurt individuals, it would create a dangerous cycle for the whole market, wouldn't it?
Oh, absolutely. A death spiral scenario, potentially. Estimates are maybe 4.8 million people could lose coverage altogether. And who drops out first when prices skyrocket?
The young, the healthy, the ones who feel they don't need it as much.
Exactly. The most price-sensitive people, who are generally healthier and currently, help balance out the costs for sicker people. If they leave, the remaining pool of people gets older, sicker on average, which forces premiums even higher for those who stay. You can see the whole market shrink by maybe 20, even 30%. It destabilizes everything.
And this whole fight, whether to extend the subsidies or not, it's tied up in the usual Washington drama, right? Budget deadlines, continuing resolutions.
Completely tied up. Everyone expects the decision on extending these subsidies to get attached to some must-pass bill, probably a continuing resolution to keep the government funded, or a larger budget deal, which means realistically the decision could come right down to the wire,
Yeah.
like December 31st deadline.
Smack in the middle of open enrollment season, maximum uncertainty.
Maximum uncertainty. But, and this is crucial, that massive policy threat, it leads directly to potentially the single biggest source of upside for Oscar if things go the other way. It's what some are calling the unpriced tailwind.
Okay, explain that. How does the biggest risk also become the biggest potential reward?
It comes back to that super cautious 28% rate hike. Remember, Oscar explicitly assumed the subsidies would expire when they set those 2026 prices. They priced for the absolute worst case.
Right. They baked the cliff into their numbers.
Exactly. So if Congress does act, if they do extend the subsidies, suddenly Oscar finds itself having massively overpriced its risk relative to what people can actually afford.
Because the subsidies make the plans much cheaper for consumers than Oscar assumed in their pricing model?
Precisely. The consumer cost plummets thanks to the extended subsidy, but Oscar's premium rates stay high because they were set assuming no subsidy. That difference, it flows almost directly to Oscar's bottom line. Massive margin expansion almost overnight. It's a massive, perfectly tailored tailwind because their defensive pricing perfectly positions them to benefit. And crucially, that positive outcome, it's completely unpriced in their current rates. It's pure financial upside if the extension happens.
Okay, but what if Congress waits until the very last minute? Like, say, after the main open enrollment period technically closes in December. How does Oscar make sure people can actually sign up for these plans that suddenly became affordable?
Yeah, management seems to have thought about that contingency. They expect the regulators, CMS primarily, would likely open up a special enrollment period and say why, to give people extra time to enroll or switch plans now that the subsidies make them affordable again.
And Oscar is ready for that.
Apparently so. They say they and their brokers have already used their tech platform to proactively map out which current members and even potential new members would be most affected if the subsidies get extended. So if it happens late, they can do rapid, targeted outreach to get those people signed up or re-enrolled quickly, basically capture that upside efficiently.
So the tech moat isn't just about claims and admin, it extends to managing political uncertainty too.
It seems like they're trying to use it that way, yeah. But look, the subsidy cliff isn't the only regulatory issue out there. There are other headwinds, mostly focused on program integrity, making sure people are genuinely eligible.
Right, things like the program integrity rules, PIR, and other measures trying to clamp down on fraud or incorrect eligibility.
Correct. And those rules, while necessary to clean up the market, they do tend to slightly reduce overall participation. Stricter income checks, maybe small fees for previously $0 premium plans, things like that might discourage some people at the margins from signing up, could shrink the total market size a bit.
But there was a development there recently, right? Something that softens the blow for 2026.
Yeah, there's currently a court stay, a temporary halt on some specific stricter PIR provisions, things like really tough income verification and a potential $5 fee for re-enrolling in some $0 plans. That stay is expected to hold through the 2026 open enrollment period, so gives Oscar and others a bit of breathing room on that front while they execute their pricing strategy.
And Oscar also claims they weren't hit as hard by some of the noise around fraud checks, like with dual eligible members, compared to some competitors, because they used their tech proactively.
Yeah, they made that point. While there were headlines suggesting maybe millions of members across the industry might have eligibility issues, Oscar apparently found their internal list of potentially affected members was much smaller, like in the low double-digit thousands.
Yeah.
Their argument is they use their platform to validate eligibility better up front, trying to catch potential fraud early, so that proactive defense might position them better to handle these integrity pushes without huge disruption.
Okay, so that brings us to the end game here. We've laid out the risks, the tech potential, the financial crunch, the policy wildcard. Let's try to synthesize this. How does this all stack up in the competitive landscape, and why has the market been so down on them?
Well, the market perception, you can see it directly in the valuation. It's fundamentally tied to that scary 88.5% MLR and the uncertainty around the turnaround. Investors just seem unconvinced they can pull it off. The valuation gap is pretty stark. Oscar's trading around, what, 0.45 times revenues?
Yeah, less than half-time sales.
Right. while the median for their peer group is more like 3.19 times sales. It's a massive discount.
It means despite all that growth, the market is valuing each Oscar member at only about $2,500.
Which is incredibly low compared to established profitable insurers. That valuation basically prices in extreme skepticism. It assumes they'll either lose a ton of members because of the rate hikes or the subsidy cliff, or that they'll just fail to get that MLR down and reach profitability. The market is clearly in show-me mode, waiting for proof of life.
And their strategy for 2026, focusing on profit over just sheer volume, means they have to price themselves carefully, right in the pack, as they say. Avoid attracting only the sickest members, but stay competitive enough, leveraging that network cost advantage. It's a really fine line they're trying to walk.
It absolutely is. This is a pure turnaround story. You have to weigh their genuine structural advantages, the modern tech platform, the potential for AI-driven efficiency, their decent member satisfaction scores against this immediate pressing crisis driven by market morbidity and huge policy risks.
So boiling it all down, the investment thesis really comes down to management executing on three critical things in the next year or so.
I think so. Number one, sticking to that disciplined 2026 pricing strategy, even if it means slower growth. Number two, actually hitting that 80% MLR target, proving they can manage medical costs.
Sure.
And number three, delivering on that $60 million SG&A cut, showing they can control internal spending.
If they can nail those three operational goals.
And the ultimate catalyst, the thing that could unlock massive immediate upside, is that one big unpriced variable, the political decision in D.C. on extending the subsidies. Because remember, they strategically priced that out of their base plan. If Congress does extend them, that margin expansion flows straight through. It could instantly validate the entire turnaround thesis.
It really is a high-wire act, isn't it? Balancing this cutting-edge tech vision with the messy realities of healthcare costs and, frankly, unpredictable politics.
Absolutely. Which kind of brings us to a final thought, maybe something provocative for you, the listener, to chew on. Oscar's whole identity, their whole pitch is built on their technology, right? Their code, their algorithms, their data-driven approach to managing care and risk.
Yeah, that's the core advantage they claim.
But when you see just how incredibly dependent they are on the specifics of the ACA marketplace, where the basic affordability of their product for millions rests entirely on federal subsidies, which are subject to these intense political battles in Washington.
It makes you wonder.
Yeah. Is it actually possible for a truly tech-driven insurer in this space to fully control its own destiny? Or is its foundation always going to be inherently vulnerable? Resting not just on great tech and execution, but also, fundamentally, on the shifting, unpredictable sands of politics and congressional budget fights. That deep dependency, maybe that's the ultimate, inescapable risk baked into this model, no matter how smart their AI gets.